Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And what a week it's been. I know we say that frequently, but we have continued to see volatility and hoping that gold finds some firm footing here in the same range that it's really been at for a few weeks in terms of a bottom. And that's where the chart expert, Mr. Miles, comes in. Why don't you throw that up, Miles, and tell us what you're seeing?
Yeah, thanks, Tori, and welcome back to the great 2022 decline as we're seeing across the board here in metals as well. I think this week it's a good time to chat about how markets move together, which we're seeing. So we'll definitely get into that here in a little bit with the great DXY dollar index rise and the decline across the board in pretty much all markets here going forward. So for me, the big question, of course, is going to be, is the dollar really the strong gem that we all need it to be? And I think we know the answer to that, at least here domestically, when it comes to cost of living. So, as you mentioned, gold, yes, taking a nice dip down. We're at the 618 Fibonacci level as of this morning, which is a nice potential reversal point. RSI hasn't shown any divergence. RSI hasn't even gotten to the oversold level yet on the daily chart. So it is possible to see some continued decline in gold as our other markets continue to fall. And I think there's a darn good chance we're going to see these other markets continue to fall as we get into the equity market charts here. So where will gold go from here? I mean, certainly this could be a reversal point at this price. I'm not buying into that yet. It is possible we do continue to see gold go down from this point, or if we see some type of reversal, I would argue your high water mark, you'd have to look for a breakout level in gold, really puts us back up into the low 1900s, maybe around 1910, get above some of the top end pricing that we saw back at the end of April, beginning of May, before we had this last little leg down here. So looking for 1900 gold on the upside. Downside, I think your next stopping point is even sub 1800. Now, I know that feels like a lot of down movement. I do want to recall a chart we had up last week, and I think we throw it up again, and that's just watching what the dollar has done over the last 5 years compared to gold being up 65% at this point. It's not unreasonable to have reversals, and going back less than a year ago, gold was 1680. And we're still in the mid-1800s. So there's no reason to be pessimistic. The markets don't do what you want them to do on a day-to-day basis. Gold is clearly in a bull market, remains to be so. It is a multi-year directional move that will take time to play out. And when you have these minimal reversal points over a short period of time, that's just opportunity. That's not a fear mandate.
I actually love it because the underlying fundamentals haven't really changed. You get a lot of Fed speak and everything else. But I'm also wanting to throw up two images from a couple of weeks ago. You had the short-term and the intermediate-term gold charts, and it's the numbers that are playing out.
Right.
1853 in that short-term chart is a key support, and you had an 1841. Well, guess where we bounced off of yesterday? That was the 1841 mark with a correlating subsequent silver pullback as well. So gold's not doing this alone, but keep in mind, too, it's still up on the year, and still we've given up some of the first quarter gains. But where else would you want to be? Let's look at silver.
Yeah, minus the premiums in the physical silver market, which have now finally made their way into 1,000-ounce bars. So everything across the board is running at a premium in silver right now, which tells me that the silver manufacturers, wholesalers, miners have a higher belief in the value of their product than the SLV and the New York Metals Exchange do.
Hear that. The physical market is not chasing the spot price down.
No.
That's why the premium's climbing. The spot price is dropping. The physical market is stopping. We saw the same thing in 2008. So hold on, everybody, and just know that the big money is telling you that silver's going to reverse back up. But show us chart-wise.
Right, and here's what's interesting about silver. Gold is now down to its 618 fib, and I've always argued that silver is just gold but more volatile. You know, it's like gold but a kid on Mountain Dew. It does more yelling and screaming on both sides of it. Well, gold's at its 618. Silver's just barely scraping its 50% line. So silver actually hasn't corrected percentage-wise as much as gold has. And I think that's very optimistic for silver. Now that's brought the ratio back up to well above 80.
Yep.
Even in product, you know, even if you account for the premium in physical product being up, you're still looking at silver bar to gold bar product ratio over 80. So silver has become enticing for me again. I'm still big fan of platinum, and as we'll see, platinum's doing the opposite of everything else. Platinum's actually going up, but silver is becoming enticing for me again now that we're back up in the 80s, and I think is something worth taking a look at.
Well, again, throwing up an image from a couple of weeks ago, you had that 2117 and like 1941 being the intermediate retracement there, $19.41. But the 2117, that was again yesterday, and I loved it. My clients with money on the sidelines, yesterday was a huge day. We moved a lot of money into gold and into silver as a result of three things. One, we saw that 1841 in gold. We saw $21.17 hit and bounced off of in silver, and we got a 3% pop today. But we saw the ratio at 85-1. So you talked about the ratio, and that's something that can't be missed. Remember, this time last year, we got down into the low 60s on that ratio. Now we're in the mid 80s. That's a 20-point differential. That's big. Keep an eye on that. And as we get higher into the 90s, maybe we go top 100 again. But those are opportunities that no matter what the spot price is doing, that's activity in our clients' accounts because we can ratio trade and do some swaps where we're compounding ounces. So if silver drops further and does hit that 1941, I'm all for it. Again, that's a ratio opportunity for us.
And finally, in the white metals, platinum. I pointed this out a week or two ago. Platinum was coming into its third touch around 900 at its 618 fib. And platinum reversed and has come back up. And in fact, it looks like it might be breaking into a little short-term higher high here around 995, probably pushing over 1,000. So I think there's a chance platinum could continue up here, which would be very strong. Looking at how RSI moved, RSI failed to go oversold, and we had a reversal. That would mean you're just pulling the drawstring back to let the arrow fly on platinum. What an interesting world it'd be after the last couple years of platinum, which had been lagging behind, actually starts leading the charge. And we know that has to happen eventually because of the ratio price that we've been looking at between platinum and silver, platinum and gold, how platinum has lagged behind significantly and has needed to play catch up. Platinum needs to play catch up to get to its historic averages with gold as much, if not more, than silver needs to. And this is the type of thing where I could be making this all up right now today, or we look back a few months from now and go, yep, that was the turning point in platinum. So I continue to be a fan. Anything below 900 in platinum, if I'm wrong, and it does continue down, I think your next stopping point is all the way down around 800. So big potential range here in platinum, but it is a very solid floor at 900 that we've touched 3 times. Put in a higher high. If we go in and put in another higher high, I think platinum takes off from there.
I think that it's been very bullish, very stable and encouraging here in the short term, but I think it's a long-term play, whether we come down or not. I don't know that platinum is going to have what it needs economically. So as we look at underlying fundamentals, economic indicators, quote unquote, will start screaming if the Fed hikes rates further. That comes from Cathie Wood of ARK, right? So we know that. The consensus really is that there's a recession around the corner. And with the industrially sensitive metal like platinum, again, very bullish over the long term. I just am hesitant to think that in the short term we should see some pop short of some geopolitical tensions.
What a great transition to look at what the markets are doing. And I think you've got a good argument there. Platinum supply coming out of Russia and sanctions on Russia is obviously going to have a positive effect, not on the platinum market. Sanctions are difficult for people who need to use the product, but are going to have a positive effect on the price for anybody who owns it from a investment standpoint, because that is siphoning off a good percentage of the world's platinum supply. So we are going to see that take effect. But on the flip side of that, we're seeing major problems in all indices across the board. If you take the high water mark, if you look at a lot of the markets capping out the end of December, beginning of January. So we're looking at a couple week period where most of the markets hit highs. The transports are down 22%. The industrials down 14%. The NASDAQ is down 28.5% since its high.
Bear market.
Yeah. Gold is down 11%. It is coming down with other things, but nowhere near as bad. And it's actually coming down almost identical to what the dollar index is up, about 10%. Bitcoin, digital gold, right? Isn't that what everyone thinks it is? Bitcoin down 58% off the highs, and not exactly being the safety net that people were hoping it to be.
No, and I think it actually for a bit there was 60% down. So I'm not here to talk badly about the cryptocurrencies or Bitcoin in particular, but for years we've heard that it's the new gold, that it's the hedge, it's replaced gold as your portfolio protection. No, it's not. And again, there's been a lot of money made and it has far outperformed gold from a speculative investment standpoint. But from a hedge and a store of value standpoint, gold is doing exactly what it's always done in a completely different way than what Bitcoin has been doing. And so I hope that that whole debate is over now, that cryptocurrencies and Bitcoin in particular have replaced gold. Well done, gold holder. Well done, crypto holder. Understand the diversification.
So once again, all of this falls on the back of the U.S. dollar and the Federal Reserve Bank and their expectations. I think the dollar is climbing exactly the way you would expect it to, given the announcements coming up, expectation of long-term rising interest rates, even though they are expecting to not have to raise it as much as they were thinking this summer. We'll see what happens when June, July actually roll around. And the dollar getting back to that third time and actually now breaking above 104, which it's been trying to do since 2017. But, like I mentioned earlier in the show, and here's the chart again, we looked at it compared to gold over the last 5 years, and the dollar has struggled to maintain that level, and gold is up 65%. It's important to look at these things relatively. Oh, and by the way, it didn't cost me $75 to fill my gas tank up 5 years ago either. So we can argue that the dollar is at the same price level as it was 5 years ago, but like I said at the very beginning of the show, no, it ain't.
No, it's not.
Not in purchasing power.
And it's not quite done. We may be seeing a peak. We talk on this show about gold and silver predicting and really leading by 3 to 6 months the rest of the commodities. So in 2020, they led the way up, and then they reversed and they led the way down by a few months. Are we starting to see the same thing where it's signaling peak inflation? Maybe, maybe not. It depends on what the Federal Reserve can do, but persistent high inflation is here for a long time. This stagflationary kind of setup that we're in is going to be something that we're stuck in for a while. But the new numbers came out this morning, 8.3% CPI, down 0.2%, but the PPI is at a new record, 11.2%. That's the producer price index. That's the cost of all goods sold. Eric, who's been on this show a lot, told me too this morning, all eyes should be on diesel. Diesel is going through the roof and there's a shortage. Now there's a major supply issue with diesel. Well, that not only impacts trucking and the transports of goods, but manufacturing and what a lot of manufacturing facilities are operated on. So you talk about this delayed effect of these elevated prices. It's not just the oil market, but we are seeing commodities start to roll over. And I'm wondering if gold and silver aren't predicting that. And then they'll start to reverse and once again lead the charge back up. But the Federal Reserve's got a big battle on its hands. Don McIlvaney said for decades that the next Great Depression is going to be an inflationary depression. And all signs kind of point to that being a reality. Now, inflationary depression will ultimately lead to a deflationary depression. Perfect example of that, you're getting some deflation in some markets right now that are also economically stagnating and destructive to individual portfolios, and that's in the form of Luna. So again, not to pick on the cryptocurrencies, but look at Luna. In 5 trading days, it's down 98%. It's gone from a market share of $32 billion to $600 million in 5 trading days. That's a lot of money that's wiped out of the system. Again, too much money in the system right now is part of the inflationary problem. Watch what happens deflationary-wise when all of these billions of dollars get completely eradicated digitally.
We were talking earlier before the show, and I brought up John Maynard Keynes, and my favorite quote of his, "Wealth is neither created nor destroyed, it simply changes hands." I'm calling that one out, and I think you brought up a good point, Tori, when we were chatting earlier. This ability to create money digitally by the Federal Reserve Bank didn't exist in the 1920s. And I think what we are watching here with the dollar index taking a minor climb up, because we know some of that equity money is going into currency. It is flight capital going into liquidity. But the dollar index increase isn't accounting for all of the losses taking place. We're seeing unwinding of hedge positions. We're seeing unwinding of leveraged positions. And with that, I think we are, like we did back in 2008, beginning to see the destruction of value. Or better to say, the destruction of leveraged over value. And this is how recessions are made, right here. You have the unwinding of a leveraged position, which starts to take out 401ks and retirement accounts and investment accounts. You have the increase in commodity cost, which flows into the manufacturer, which causes the PPI to go up, and then CPI is going to be not too far behind. So you ask a good question, and Don McIlvaney quote may be correct. Is the next recession an inflationary one? Is the next depression an inflationary one? Maybe, but I think all of that hinges on Jerome Powell. Who is Jerome Powell going to be when things hit the fan? Is he going to be Volcker and stick to his guns? Or is he going to be Greenspan and give up the ghost and put interest rates back on the floor when things start getting ugly?
He's going to have to.
Volcker didn't.
It's not possible to create $7 trillion and then raise the interest on that debt. It's not sustainable. It's not possible. So I personally think that they're going to try. They're going to see how economically stifling it is and how many people are screaming about it and how unserviceable the debt becomes, and they're going to have to lower rates again. So if anybody thinks that we're getting towards a positive real rate of return in this environment, you're crazy.
Right.
We're minus 7%. It might eat away at that a little bit, but that's the market that you buy gold in. For the gold investor, I'm going to throw one more piece up here that we'll close on, and this is a piece of encouragement. Look at the S&P 500 return in significant bearish markets over the last 100 years in the United States, and then look at the gold return. And then look at the differential. So the gold return relative to the S&P 500. This is showing that even right now, gold is doing and always has done what it's supposed to do. Be encouraged.
So that's going to do it this week for Golden Rule Radio. As always, we encourage you to pay attention to the markets. And a little special encouragement, pay attention to Jay Powell. It may be time to place your bets. Who's he going to be? So going forward, if you want to discuss that and your personal portfolio, how you can protect yourself from both an inflationary depression, which gold does incredibly well in, and a deflationary depression, which guess what? Gold also does incredibly well in, and we can explain that too if you'd like. Give us a call sometime, Tori, myself, or anyone else here, Robert. Anyone's happy to chat with you about your personal portfolio. We can be reached at 800-525-9556. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And our website is McIlvaney.com. Thanks for listening. Have a great week.